Welcome to the art and science of trading as a business. There's two components to this program. There's the monthly income, what we call money every month. And then the second strategy is the strategy for massive market profits. First, I want to talk to you specifically about the program itself and what it hopes to achieve and what the objective of the program is. The objective of the program for the first part is the money every month program is to generate just what it says, money every month. We want to generate a consistent income on a monthly basis in our trades so that just like any other business, we want to generate recurring, consistent monthly income. Does that mean we're going to be profitable every month? Maybe not. Maybe we will. The important point to think about, though, is that we really want to have a monthly income stream. In order to generate a monthly income stream, we're going to be using options as our primary trading vehicle. Now, every business manages their business based on numbers, and that's exactly what we're going to do in ours. This is a real business. It's a business in which you are buying and selling. Any business that buys and sells things, and it doesn't matter what it is, it could be a bakery, it could be a auto repair shop, it could be a parts store, it could be a gift shop. You have to buy your stock from someplace and then you sell it to a customer. Well, the very same thing happens in the markets. You're buying and you're selling. Let me give you an example of how we actually try to make our money in the markets as a business. All we're doing is really meeting supply and demand. Let's take, for example, a stock such as Activision, which we have on our screen right now. The symbol is ATVI. It's currently trading at $27.23, down 27 cents today. Now, for the most part, you have people in the market who believe that ATVI, Activision stock, is going to go up. You have other people who believe the stock is going to go down, and that's what makes a market. On the if we take a look at this, the options on this particular stock, we have what's called call options. We have puts. Calls are those options that people purchase if they think the stock is going to go up. People buy puts on this stock if they believe the stock is going down. If we take a look at what is called at-the-money options, this is the May contracts that expire on 24 days. The 27.5 or 27.50 options, if you wanted to purchase a call option on this stock because you believe it's going to go up in the near future, you would be purchasing this option for 45 cents. If you thought the stock was going to go down, you would be purchasing this option for 80 cents. Now you could try to get a price that was in the middle between the sell and the bid and the ask, and maybe you'd pay 70 cents. But the point is that you have to buy these options in order to fulfill the idea that you have that the stock is going to go down or the stock is going to go up. So let's say you think that the stock is going to go up. So you purchase this call option on the May options for Activision, and you get it at 40 cents, almost in the middle of the bid and ask price. Well, at 40 cents, this option actually has no real value because the current price of the stock is at $27.23. So not only do you have to be accurate as to your timing, because the stock would have to move quickly in order for you to make money, but you also have to be accurate as far as direction goes. The stock has to move up in order for you to make money. If you were to purchase a put option, let's say you got it for 70 cents, not only would you have to be correct as to the direction of the stock, it would have to move down in order for you to make money, but your timing would also have to be correct because it would have to move down relatively soon in order for you to make money. Because there are only two absolute rules of the option markets. Those two absolute rules are, number one, prices will fluctuate. Yes, the underlying price of the stock will fluctuate and the individual option prices will fluctuate. Number two, the only other rule, absolute rule of the option market is that these contracts will expire. Any option contract that you buy on any stock will expire at a certain date in the future. If we were to purchase these May options, the ones that we're looking at right now, expire, and we have the expiration date right here, in 24 days. Normally, the options expire on equity and index options the third Friday of each month. That is the last trading day for those options. They actually expire the very next day on a Saturday. You can also pick the expiration dates that you're interested in purchasing. So, for example, if you thought there was an imminent move in Activision, you could purchase this option for 40 cents today at $27.50, and if the stock did move up beyond the $27.50, you would actually start making money. But what happens if the stock doesn't move? Well, if the stock doesn't move, slowly, day by day, this option that you purchased, if the stock does not move, would slowly erode in value. Why? Well, the reason is that you have the right as a call buyer to purchase the stock at the strike price that you purchased, in this case $27.50, at any time before the third Friday of May. As we get closer to the third Friday of May, the chances of that stock moving up beyond this strike price of $27.50, above the price of $27.50, becomes less and less certain. And because of that, the option has less value to it. If the probabilities are less that the stock will actually move above $27.50, then obviously that the value of holding that position, that contract, becomes decreasingly less expensive. So, I mean, if you take a look at an option like this over time, let's say that the stock doesn't really move. If over time, like a week from now, maybe this option will be selling for 20-cent bid, 35-cent ask. A week after that, it's 15 cents and 20 cents, or 25 cents. The week after that, maybe it's 5 cents and 10 cents. So eventually, the option that you purchased at 40 cents with great hope that the stock was going to move up is now only worth about 10 cents. You've lost 30 cents on the trade. Well, that's exactly what the person who sold it to you is hoping would happen. That in fact, that the stock did not go up in price, that you purchased this option that they know is going to expire and will eventually erode in value over time. And that's how they make their profit. Because they sold it to you at 40 cents, they can buy it back at 10 cents, making a 30-cent profit on that trade. Well, what about the guy who purchased the put option? The option that gives him the right to sell the stock at $27.50, hoping that it would go down so that he could buy it back at $22.50. If he could buy it at $22.50 and sell it at $27.50, he's made a $5 profit. And that's what his hope is. Now, if the stock doesn't do anything at all, the same exact thing is going to happen to his put option. Eventually, over time, because the actual probability that the stock is going to decline in price decreases as these options get closer to expiration, the third Friday in May, for our example here, then eventually this option will be worth less and less each week. Let's say next week at this time, if the stock does not move, then this option will only be worth maybe 45 cents to 65 cents. Another week passes by, and now it's only worth 35 cents to 45 cents. Now another week passes by, and it's only 25 cents. See, as long as the stock does not move, these options, all of these options will continue to decline in price if they have extrinsic value. Now the prices of the options, these are called in-the-money options. The in-the-money options have some component of what they call extrinsic value and some component of intrinsic value. And the way you can determine intrinsic and extrinsic value is simply by taking the strike price of the option. In this case, we're taking a look at the May 20 calls. and they're priced at $7.40. On these 20 calls, if you add the strike price to the price of the call, you get $27.40. At the mid price, you're probably talking about closer to $27.25 or $7.25 for the price of this call option, which is exactly the price of our current stock. So you could say that this call option has no intrinsic value. In fact, if we look under extrinsic value, you can see that it is actually zero. The closer you get to the at the money or the actual price, strike price of the stock, you can see that there is in fact some extrinsic value left. There is some time value left in that option, and that time value is basically saying that, hey, you know what? We do have 3 or 4 weeks before expiration, so the price of the option may actually increase to the point where it might be actually further in the money. What is our objective, though? Okay, this is just a very brief. You should have already a basic understanding of options. I probably haven't told you anything new, or maybe I have, I don't know. But depending on your experience. The important thing to remember, though, is that when we trade for monthly income, what we hope to do is not only sell options, we are going to sell both sides. We're going to sell calls and we're going to sell puts. The reason for that is because the stock cannot be in two places at one time. In other words, if you sell this 27.50 and you sell these 25s, well, it can't be both at 25 and 27.50 at expiration. We're going to make money on one side or the other. And that's an important distinction to make because we make money whether the stock goes up or down. Now, the types of vehicles that we use in order to trade options on the exchanges are normally going to be, and I'll go through all those with you in the next series here in portfolio building. What we're going to be using are normally what are called calendar spreads and the sale of vertical spreads, specifically double calendar spreads and the sale of iron condors. Those two strategies will comprise most of our system and most of the trades for the month so that we can make a monthly income and generate a monthly income. Let me just show you the trades that we currently have on so you can kind of get a picture of what I'm talking about. These are trades that we just put on recently. We have 4 positions. We have a iron condor, sale of an iron condor in the diamonds, which is a ETF that mimics the Dow Jones Industrial Average. We have a double calendar rather on the EEM, which is the Emerging Markets ETF. We have a double calendar position on the IWM, which is the Russell 2000 Index, ETF for the Russell 2000 Index. And we have the sale of an iron condor on the SPY, which is a ETF on the S&P 500. These positions, normally when you put them on, all show a loss at the open. However, there's a couple things that you really need to take a look at. Number one, this white line here is what our current profit and loss position is. You can see that the current price, the live price of our portfolio based on the S&P 500, or on the SPY rather, ETF is right here. And in fact, it is in the center between our break-even points. Our break-even point on the low end is down here around 133, and our break-even point on the upper end of the price chart is 143.65, someplace around there. And we are directly, almost in the center of that. Since we just put this position on, we are in a position of a slight loss in our position. However, what we need to take a look at is what happens, as I told you, to a person purchases an option. Now, we are selling them that option. We are the seller. And there's 2 rules of the market as far as options go. Number 1, they will fluctuate in price. And number 2, they will always expire. And we take advantage of both of those absolute rules of the option market. And that's what makes this strategy so powerful. Number 1, it fluctuates in price. Well, as you can see, we have lots of room to move. Right now, we're about in the center of this little tent. This is, I explained what this white line is. That's our current profit and loss position. Well, we're currently in a losing position. However, the maximum profit on this position is represented by this green line. The green line is what happens to that option at expiration. And as you can see, if you take a look at this down here in this corner here, if the options were to expire today, we would make a maximum of $1,249 on this position. It's 5/17/08, and we have $1,252 in potential profit in this position at expiration. Today is 4/22, and we have a loss of $79 so far today. If we hold this to expiration, remember what I told you back here, these options slowly will decline in value until they get close to the expiration date, which is the third Friday of May. That's what this green line represents, the third Friday of May. Eventually, this white line will continue to go up and go up and go up and go up until it meets this green line in which we've achieved our maximum profit. And that's how monthly income is derived from the markets. By selling options to people who want to buy them, who are taking bets basically on a stock, whether it's going to go up or down, and it doesn't matter. To us, it doesn't matter. If the stock goes up or the stock goes down, we make money both ways. Our maximum actual profit position will change depending on the price of the stock itself. So we may have a little bit more profit or maybe have a little bit less profit, but we take advantage of one of the major undeniable rules of options is that they will fluctuate in price. Number two, we take advantage of the second rule of option trading is that, and that is that all option contracts expire. Once they expire, they either become worthless, or if they have intrinsic value, if they're in the money, they do have some value left to them. We take advantage of those options that are generally out of the money, that have a low probability of actually being worth anything at all, and capturing that so that we can make money. Now, does this work out all of the time? Well, it does and it doesn't. And the reason I say that is because prices do fluctuate. For example, if you put this trade on and then all of a sudden the prices ran up very, very high and all of a sudden they were very close to your break-even point, what would you do? Well, you'd be in a losing position. Also, if you were far from expiration or if you were close to expiration, then you might show a small profit here. And the real key to making the system work is adjustments. Adjustments are everything because, as I said, prices fluctuate. And that's one inviolate rule of the market. Prices will fluctuate. We don't care if they go up or down, but they do fluctuate. And once they get close to our break-evens, then we have to adjust our position so that we do not go into a losing position. There's a couple rules of the option markets, and that is that the two I've already told you. The third one is don't lose money. Okay, so yes, the rules are prices fluctuate, options expire at a date in the future, and the third rule is don't lose money. So in order not to lose money, many times we have to do adjustments to our original positions, and this is where a lot of option players make a mistake. They do not adjust their positions. They put a position on, they believe that they can just keep it on there until expiration, and then walk away from the position. Well, they forgot about the other rule of the market, and that is prices will fluctuate. Yes, they do expire, and that's where if you're an option writer or you're doing credit spreads, you can make money. But what most people don't realize is that not only do options expire, but they also fluctuate. So if you get into a position, and a lot of option players do this, they just put positions on and they forget about them, and they don't even look at them until they have a loss. And then it's too late to do any type of adjustment to that position because they're already too far gone. Our goal is to monitor your positions, put these positions on within 30 to 40 days to expiration, and then we will show you exactly what you need to do in order to adjust the positions when the prices fluctuate to the point where you're going to be in an unprofitable position. And that's where the majority of the real profits come in this business. Because, what happens to a business when it's not making money all of a sudden? Well, just like this, if we're not making money, then we have to take a look at the source of the problem and adjust our strategy in order to take advantage of new market conditions. And that's exactly what any business has to do. Any business who is not in a profitable position has to take a look at their business model and adjust their either they have to adjust their expenses, or they have to adjust their marketing and sales, or they have to cut back on expenses someplace, but they have to adjust to current market conditions, and that's exactly what we do in our business of trading. And that's why it really is a business, because we manage by numbers, and that's what all good big businesses do. They manage by numbers. So now this is an aggregate position of our demonstration account for the purpose of these videos. You will see this throughout all the videos that we're creating on this strategy. We start out in a cash position, and we normally trade. I'll show you down here. We normally trade maybe 3 contracts, 2 contracts, or 1 contract. This not only gives you, if you're just starting out, we suggest that you trade in 1, 2, or 3 contracts at the most in these positions. The reason for that is it's much easier to be calm, cool, and relaxed if you do have to do an adjustment and the position is a losing position and you need to make an adjustment in your position. You're going to be a lot more relaxed if you have 1 or 2 or 3 contracts on than if you had 10, 20, or 30 contracts on. But I also want to show you what the profit potential of having more contracts. Eventually, as you get experience in this type of trading as a business, you're going to be able to have a great deal of confidence in your ability to adjust trades over time. I suggest that you begin with paper trading. Now, the Thinkorswim platform has a paper trading account that you can set up for free. It looks identical to this. The only thing that is different is if you look up in this top left-hand corner, this is a live trading account. It has a red symbol here with the Thinkorswim symbol and logo. If you have a paper trading account open, this is a green symbol. But the platform is absolutely identical. Everything is exactly the same. You can enter trades, you can adjust trades, you can look at charts, you can monitor your account. You can do everything that you can in a paper trading account with Thinkorswim as you can in this account. Take a look down here in the right-hand corner. In order for us, this is an aggregate graph, a picture, and you're going to find that these pictures are extremely important for us to monitor our trades. This is an aggregate position of our entire portfolio of the 4 positions that we have in the diamonds, the EEM, the IWM, and the SPY positions. This is what they all look like. If we were to monitor individual positions, for example, if we wanted to open our IWM position, all we'd have to do is enter the symbol in there, and you can see that the graph looks almost identical because we are still in all of our positions in a portfolio basis. If we went to a single symbol, that's exactly what our current position in the IWM looks like. We are not in the center of this position. We're just a little bit off to the left, but I think we have upside potential, so we're going to maintain this position. And if necessary, we will adjust it. Let's take a look at our EEM. Our EEM position, on the other hand, is looking very, very good. We are exactly in the center of our position, exactly where we really want to be. In our SPY position, this is an iron condor. We're exactly in the center of this position. Now, a few days ago, we actually had to adjust this position. It would have taken a loss on this position because it came very close to our break-even in a large market move. But in our case, we actually made money. And I'll show you how that happened in the adjustment CD. Also, we're going to go, let's take a look at our diamond position. Our diamond position is also looking very good. We're almost in the center. We're just slightly off to the side, but we have a great deal of room. Now, the diamonds, remember, imitate the Dow Jones Industrial Average. So if the diamonds are at 126.99, that means that it's pretty close to what the Dow Jones Industrial is at 12,700. If we take a look over here, the Dow Jones is actually at 12,714. What is important is the fact that it does mimic the Dow Jones Industrial Average. So if you take a look at this, you can see that it's at 12,700 in equivalent Dow Jones Industrial points. We have a downside break-even point of 12,300 or so, which is a 400-point move in the Dow Jones Industrial, and we have an upside break-even of 13,270. So that means that we have close to a 500-point break-even to the upside. These are the kind of positions that we like to put on. We like to put on positions that it doesn't matter whether the indexes go up or the indexes go down. We make money either way. There we are on a portfolio weighted basis again, based on the diamonds. We have a great deal of potential on either side of this to make money. Our maximum expiration profit and loss figure is the green line. Our current position is the white line, and that's how we manage our trade as we go forward. You'll see both positions that we've closed out on the future videos. We're doing adjustments. I will show you exactly how to manage your portfolio based on the Greeks. Don't let those Greeks confuse you or make you uneasy at all. I will simplify them to the point where you will understand exactly what delta, gamma, theta, and vega mean to your position. And we are going to be managing our positions based on the entire portfolio and manage them by using these Greeks in order to determine exactly when we need to adjust our position so that we remain profitable at all times. We'll also take a look at some big picture ideas as far as technical analysis goes. I'll also show you exactly how we trade, how we select our trades, and the strategy that we use on our trades. It's absolutely critical to understand how our trades are created and how they're selected. And this is where the part of really trading as a business comes in, because we don't trade without a plan. Now, if you go into any kind of business, you're going to create a plan, whether it's just on a single piece of paper or even on a napkin, but you're going to have a plan for that business. It's absolutely critical that you trade according to your plan. You don't trade by the seat of your pants. You don't go into a market and just trade by buying and selling options of any kind without really knowing what you're going to do in case the option that you're purchasing goes against you. So you got to have a plan, and that's where the trade selection strategy comes in, because we take a look at how these trades are selected, how we plan out the trades, how we select them based on support and resistance points in the underlying index, and how we go about adjusting them. And the adjustment videos are probably the most crucial part of this entire system, because once you get into a position, it's easy to take profits when the market doesn't move, because those options will simply expire and you collect the cash. But what happens when the markets move against you? So you have to know exactly what you're going to do ahead of time. And that's why we always say trade with confidence, because if you know ahead of time and you have a plan of how you're going to adjust your position so you're always in a profitable position, then you are not going to be afraid. You're going to trade with confidence. So that's our overall objective, if we really want to simplify it, is to take this white line, which is our opening position, and sit tight until it rises gradually up to this green line where we take our maximum profits. Normally, we don't wait till expiration to take our maximum profits. We normally take our profits right around the 50% to 60%, sometimes a little bit higher, depending on the current market conditions. We don't normally go all the way to expiration, and there's a reason for that. Normally in the last week of expiration, before an option expires, there's a lot of things going on with that particular option that can affect our position. Also, price could be a risk. Depending on current market conditions, we could have a profitable position, but if we go into the final week of expiration, then the position may become unprofitable because of price risk. So normally we don't want to take those type of risks, and we take the position off prior to expiration, usually 7 to 10 days prior to expiration. And that's not such a bad thing. And I'll tell you why, that nobody else will probably ever tell you, not anyone from retail investor, probably not any market maker either. I'll tell you this now, but you may not understand exactly what I'm talking about. But these Greek positions, the delta, the gamma, the theta, and the vega, will change dramatically as we get closer towards expiration. In fact, theta may drop off dramatically. Theta is the primary profit producer for these types of positions. We want this theta number to be positive at all times. The closer we get to expiration, because we're doing a lot of out-of-the-money credit spreads and double diagonals, there may not be much theta left. In other words, if there's not much profit potential left in the position, why keep the position open? Because there's only 7 days left to expiration, the options that we've written are extremely low priced options. If there's only $1.83 of theta left on a per day basis, why take the price risk? Why take the risk of the price moving against you when there's only $1.83 of profit potential in the position? It doesn't make any sense. It's just like a business that has a very low margin item. Let's say you have to pay $850 to a wholesaler for, but you can only sell it for $900. Well, it doesn't make a lot of sense to keep that kind of a product in your stock at such a high cost when there's very little profit potential in it. It's the same thing here. We only want to keep this position as long as theta is working in our favor. Theta is the rate of decline of the option that we sold. In this case, in these positions, which are live positions, we're collecting $31.37 a day in decay of the options that we've written. If that continues to decline, then we do not want to hold that position any longer. It doesn't matter what our current profit and loss position says at this point. Eventually, theta will catch up. So that's really our goal. Our goal is to move this white line up to this green line and keep our price in the center of our profit graph here. So, hey, enjoy these videos. You're going to find a way to trade that is unbelievably profitable, that will serve you for the rest of your life, because these principles do never change. I also want to show you what the current profit potential is. Like I said, we only do 1 or 2 or 3 contracts. Now, when you get to the position where you start to have a great deal of confidence in your abilities to not only put on, select, and plan your trades, but also to adjust them, then you can do as many contracts as you want. Like I said, we're only doing a couple contracts on each one of these positions. Well, our profit potential is, at this point right here, $1,289. And that's only 1 or 2 contracts. What if we were doing 10 or 20 contracts? Well, just add a 1 to that, add a 0 to that. Now we're up to $12,890 in profit potential. And normally we only hold these trades about 3 to 4 weeks. Now, that's not a bad profit potential. This is how professionals trade the market as a business. They don't leave things to chance. They manage by the numbers. They manage their positions. And they adjust when necessary. And that's how money is made in the markets. There really is no limit to the amount of money that you can make. As long as you have the capital, you have the principal, you can make as much money as you want. That's it for this introductory video. I hope you guys really got excited about this, because it is a very exciting business to be in. You're going to have a lot of fun in this course. The videos will blow you away. You'll learn stuff that you've never learned from anyone else. Believe me, I've been trading and investing for 20 years. And it's extremely rare that anyone has ever revealed these types of trading secrets before, because I've taken the $3,000 seminars, the $5,000 seminars, and there's $20,000 courses and seminars, and there's very few people that actually learn how to do these types of monthly income trades. It's extremely rare. But once you learn it, this is the kind of stuff that you can hand down to your kids and your grandkids, because the principles will never change. Okay, guys, trade with confidence.